Hey everybody, it's Chris Kirkpatrick and welcome back to the Life 180 channel. And I'm back here with Galen from Canada. He is a financial expert in Canada. And we've decided to do a series on financial planning ultimately for Canadians because honestly, I've got a significant portion of my audience that is Canadian. And when I kind of realized that and I realized how many questions I was getting about Canadian specific, financial issues, I was just like, wow, we need to do this. And so what Galen and I have done is we've gone through and made a list of like all the differences, because quite frankly, I don't know a lot of the nuances and regulations and rules and taxes and just different strategies and tips and tricks that you can leverage and implement in your personal financial life or in your corporate financial life in Canada, because that works a lot differently than it does here in the United States. So I'm really excited about this video because what we're going to do is we're actually going to talk about how to create a pension with your corporation. And that's not something you can really do so cleanly in the United States. And so just full transparency, as we get into this, I know nothing about this topic. So Galen is going to talk about it, and I'm going to ask questions of Galen. And hopefully some of my questions will be some of your questions, so we can hopefully give you clarity around this topic as we go through this. So if you find value in this, I encourage you to like the channel, subscribe, hit the bell. That way you get notified, because Galen and I are going to be doing videos like this every single week, talking about how to how Canadians can use different financial strategies to achieve their financial goals. So that's it. So Galen, what's going on, man?
Yeah, man, thanks for having me again. And I love, we did the video and there were comments, people were asking questions, and I love answering questions because I love, before I became a financial planner, I was super confused about all the different acronyms and all the different things. And I didn't grow up in Canada. So like I moved to Canada in my 30s. So I love seeing people asking those questions and answering them. So definitely get down with the questions. And this is definitely a topic, like most of the people I get in front of don't know a lot about these options or these strategies, partially because, and my accountants will be fine with me saying this, but a lot of people think that their accountant is their financial planner, when in fact I have clients who are chartered accountants using me to put these strategies into place, because their job is not to help their clients retire. Yes, save taxes within what they understand, but there's a lot of tax saving strategies outside of what an accountant might manage, and that's part of what we're going to talk about today, and part of how to turn the corporation into a pension, how to create your own pension. And one of the big differences that I think is around, and correct me if I'm wrong, is corporations in Canada are really common. Like almost every doctor I know has a corporation. Almost every chiropractor I know, dentist, veterinarian, real estate agents just became able to incorporate.
Really?
And so there's a lot of professions that can incorporate: physiotherapists, social workers, like just a ton of them, accountants, lawyers. So the idea behind that is there's a legal protection of having a corporation that exists separate from oneself, but there's also a huge tax planning opportunity. So basically, almost any one of those professions I've named, if they're making more than, ballpark, depends on your individual situation, but if they are earning more than $120,000 to $150,000 a year and not spending every last dollar of that, it usually makes sense to incorporate. So they are very common in Canada that people have corporations.
Yeah, it's rare in the United States, honestly. Like you have to be doing better than that to have it make sense. A lot in the United States, like people do what we call sole proprietorships, which is typically just pass through your social security number. It's pass through income, and LLCs, which, you get some protections legally, but it's still pass through income through your social security number. So there's not a lot of tax benefits, if it's a single member LLC. So.
Yeah, no, once you have a corporation in Canada, and like I said, the barrier to entry is pretty low compared to the States, seemingly. Once you have it, you have basically a valve in your control to decide how much money you take out this year, how much money you take out next year. It's a great way to even out income. And we'll get into some of the other planning opportunities.
I look forward to hearing it. That's awesome. Rock and roll. So where do we start?
Yeah, so I'm just going to share my screen. I thought that, well, actually, one thing I will say really quickly is that one of the big things that I find with the people I meet with, doctors, business owners, is that there is the idea that, okay, entrepreneurs, I went into business for myself, doctors, I became a doctor, and they have foregone the safety net of a pension, of group benefits, because in Canada, You don't get any of those things when you're an entrepreneur. You don't get any of those things when you're a doctor, or most professionals. But the beauty of it is that you can create your own that is oftentimes better than what people out, a regular employee would have available.
Awesome.
And you're not dependent on someone else like changing the rules on you
Yeah.
or firing you, and then you no longer have a pension. Like really at the end of the day, like a lot of people I meet with, like I did a survey in a financial planning group for physicians, and I said, if you had a magic wand, what would you do? And they said, if I had a magic wand, I would create a pension, because that idea of retiring and then just having a paycheck keep coming is very attractive for people who have spent their whole lives working hard, their whole lives, a big chunk of their lives maybe in debt, a big chunk of their lives, not having a lot of control. And in my own clients, I do have a few who were teachers, employees, and they do have pensions. And those people are pretty darn calm when it comes to money, because they've got money coming in and they're not worried about the markets. They're not worried about things. So that's really what I look to create for my own clients, is
That's
to
amazing.
say, look, you can still create it.
I love that. And one of the things that I talk about with people all the time is focusing on ROR, not as rate of return, but return on result, right? Like, and it's like, what do you want to accomplish, right? Like I'm a huge believer, and at least in the United States, and I'm looking forward to like getting deeper into this with you week after week and understanding how it works in Canada. But most entrepreneurs, I always kind of coach people, is like, traditional financial advice says, take your money, put it in tax deferred accounts, which, as we know, is not a tax break. It's a tax deferral, which can cause all sorts of other issues down the road. But they want you to put money as an entrepreneur into these like solo 401ks or 401ks or IRAs or something like that. But what that's doing is it's taking money away from you, and it's taking money away from your business and putting it into somewhere where you can't touch it. You have no access to it. You have no liquidity of it. You can't use it when you need it for emergency or opportunity until you're 59 and a half. And there's all these like negatives to it. And the best case scenario over the long run is you might get 6 to 8% return, right? Like that's the best case scenario. So like when you think about what you're giving up compared to what you're getting, it's like really laughable. And I always kind of tell people is like, what would your business look like? What would your life look like if you were to have that and put it in a financial system that allowed you to allow your business to grow more effectively? And I would argue with most entrepreneurs, like if you can't increase your business by utilizing a system like that better than putting money in a 401k by 6% a year, then you probably should be doing something else.
Yeah. No, for sure. Yeah. Absolutely. And a big part in Canada, just like you're saying, like, I love that idea of not just rate of return. Like I say to people, yet what you make in the market is important, but it's also important what you get to keep and how you get to access it. Because, the most common place Canadians put their money in Canada is inside of a thing called an RRSP. Yeah. And it stands for Registered Retirement Savings Plan. But I joke that the first R actually stands for rules, because there's so many rules about what you can do once the money's in there and how you can invest it and how you can take it out. Whereas in the case of my clients, I create things that have more flexibility. And so I'll just dive into it. Yeah. I'll share my screen and I'll go over sort of the common drawing I use for corporate planning. So, what I look at is, so here, this circle is the corporation. It's the entity aside from the individual. And here's the individual. And what I look at is, you make $100, your corporation makes $100. In Canada, that's the first layer of taxation. So that's the first chance for taxes to come into play. Hope this blue stands out. Yeah. The first layer, it's varies from province to province, but I'll call it 10% as a round number. Sometimes it's 10, sometimes it's 12.5. It depends on the province, but that's the first place where you send money over to taxes as a business owner. And then the second place is if someone in Canada has retained earnings inside of their corporation and they go to invest it and it grows, they're going to have to pay capital gains on that.
Really?
And so that's, yeah, absolutely. And especially if they're not careful. Like that's the big thing. There are some investments that are more preferential inside of a corporation, and there's some that are taxed way worse. Like anything that generates income inside of a corporation, a passive investment. So up here down in the States, it's like a CD. Up here, it's a GIC. That thing generates income the rate of return you get on that is counted as income. And passive income in a corporation is taxed at 50% immediately. Like as soon as you make $1, it's taxed at 50%. So you have to be careful about how you're investing it inside of the corporation. And then the third place is when the money comes out to the individual. That's the third place where money can go to taxes. So I look at, and I get why we pay taxes, so I won't go into that conversation. We talked about it a little bit last time, so I'm not going to talk about whether we pay too much or too little. I'll just say what we can control. A good plan helps control how much someone ends up with. Now, the thing is that what I also look at is if someone doesn't have a corporation, and I talk about like the last $100 that someone makes in Canada, it doesn't take very long to get to the 40% tax bracket at all. And then it doesn't take too long to get to 50 or even more. The top tax bracket in Ontario is actually over 50%. So as an individual, if they didn't have a corporation, they'd end up with 50 cents of that dollar to use personally. Using the corporation, if they're not smart, they actually end up with the same 50 cents if they're not smart with saving some taxes up here, saving some taxes here, and saving some taxes here. And I'm going to go into the top 3 ways that I use to do that. And really the end result for my clients is just like I said, when they come to me, they're like, look, Galen, 20, 30 years down from now, if I've got regular income coming from a system that I've created, I'm going to be happy. So that's really what I help my clients do is they, usually when they meet me, they look a little bit like this. They're a little bit frazzled, a little bit confused about what they should be doing. And then I'm like, look, these are the 3 things we can put into place so that you'll be really happy you made these decisions. And 20, 30 years from now, you'll be happy. Your kids will be happy, spouse, like you'll all be in good shape because you did these things.
Awesome. And just so I'm clear on the corporation, just to reiterate, you could do this for anybody that has a corporation. It could be doctors, it could be dentists, it could be real estate, it could be anybody. It could be a landscaper.
Yeah, pretty much. I mean, corporations, it's pretty simple up here. There's some slight differences between like doctors and other professionals. They have what's called a professional corporation, but it's managed very similarly as just any business that has a corporation. Main difference is some of the professional corporations, they're not allowed to own property that isn't directly related to the running of the business. Like a doctor can't necessarily stuff an income property inside of their corporation. They can put their building in there, like the building they're running and using as their practice, but can't necessarily stuff another one in there. And that's a big thing in Canada that they've cracked down on consistently is what's called passive investing inside of a corporation. The tax man doesn't want people to use corporations just to shelter money. So they start limiting things like once your corporation starts generating over $50,000 a year in passive income from the assets inside of it. So let's just say if you had an investment account, if you had $1 million $1 million invested, and that million is kicking out 50 grand a year. Once it goes over 50, it starts grinding down some of the tax breaks that you get inside of the corporation. So that's one of the things I look at with my clients is when you start getting close, if any of my clients are already at that point or getting close to that point or will be at that point before retirement, we start looking at other places to put that money because it really starts defeating the purpose. If someone's left with millions of dollars inside of their corporation, generating money through investing, the tax breaks really start getting hammered because that was a law that passed or a ruling that passed a couple of years ago of like passive income in a corporation.
Yeah, that's good to know. That's interesting.
Yeah, so I'll dive into the 3 different spots where I help people with. So, I mean, first and foremost, the biggest thing that I start with, and I actually met with someone just yesterday and I was talking about this is, people meet me and they're at an age, let's say 40s or 50s and, or younger, I mean, whatever age they're at. And they say to me, Galen, I want to retire. This is them now. And this is them years down the line or however many years. And they say, look, I want to retire at this point. What I do is I figure out, okay, how much do you need per year? Like, what's that number that you're going to live off of and you're going to be okay? Oh, I want to travel. The kids are grown up. They're out of the house. Mortgage is paid off. A lot of my clients want to keep working. A lot of them don't. A lot of them are super driven people. So they don't have this idea of, sitting on the beach and sipping
they're not going to retire at 65, but the challenge is like, I mean, I know a lot of people like that too. I mean, heck, I'm one of those people. So I get it. And you also have to be realistic and realize like, when we get older, things happen, disease happens, sicknesses happen, physical disabilities happen, like stuff happens. And you want to make sure that if you're not able to work at the capacity you are, I mean, I have a former client who was, he's somebody who worked with his hands a lot and he ended up getting like this neuropathy in his hands and his hands stopped working when it was like at the same level that he needed them to, and I'm sure with doctors that could happen too, right? Like if they're a surgeon or something and, and as much as he wanted to work, he just couldn't. Right. And so like things happen.
Yeah. things happen. And I mean, also statistically speaking, they did a survey and 65% of Canadians that are working past 65 wish they weren't. And so the big thing that I say to my clients is you're going to have a choice. Like we're going to make sure that you have a choice to flip a switch, keep working if you really love it, slow down if you want to. You know, a lot of my clients, they say, you know, once I hit 60, 65, I might do like a day or two a week, you know, start slowing down a bit, but I want to stay active. You know, I think the whole idea of like going and playing golf for the rest of your life is a very antiquated idea. Like not a lot of my clients identify with that. They want to do something with their time. So we figure out what's that number, what do you need per year? And then I start looking at how much is going to come from different places using the corporation. So
awesome.
That's what we're going to talk about. So what I'll talk about briefly is like, so if the individual who is not, like I was talking about, the advantage of being an entrepreneur with a corporation or a doctor with a corporation is the individual who is an employee basically has to choose between two accounts, RRSP and TFSA. RRSP is the one that's based on the amount of income you generate. You can put up to 18% of your income to a maximum of 20 something thousand. TFSA, you get like 5,000, 6,000 a year in room that you can add to it. These are the only options employees really have. Like they have to choose between those. Most people should probably actually be maxing out both if they ever want to retire, if they don't have like another safety net. But the beauty of having a corporation is you still have these options, but you also have multiple new options. And so from a planning perspective in my end, the good news is I like solving puzzles because it starts to add layers of complexity where the decision to do RRSP versus TFSA is probably one of the most popular blog, YouTube, whatever posts in Canada. And unfortunately, that question in of itself is a bit of a ridiculous question for business owners because there's so many decisions they need to make before that, and there's so many options they have. So to kick it off, we'll talk about something we talked in our last video, which I call the insured deposit fund, which is basically tax deferred, completely tax deferred account in your corporation, which is the whole life insurance policy. So I'll just call it whole life. Like I call it an IDF when I'm throwing out acronyms, but I'll just, need to get the eraser going here.
So as you're doing that, let me just add, just for my clarity, so I can ask a novice question, as an American here, is the RRSP and the TFSA, is that like the equivalent of like the 401k and like a Roth IRA?
I'd say they're fairly similar. Like that was actually one of the comments on the last videos where someone was like, yeah, I think it's pretty similar. Yeah. So from my understanding, like if a 401k is kind of attached to an employer, it depends on you working, right?
Yeah, totally.
And then the Roth IRA is like, once you turn a certain age, you can just start using it, right?
Yeah. Yeah. And you put money in post-tax, but it grows tax deferred and you get access to it tax-free.
Yes. So yeah, the TFSA, you put your after-tax dollars into it. It grows tax-free, tax-deferred, completely tax-free when you take it back out. There's very few limitations on when you can take it back out. But the big disadvantage to using these, and I mean, I might as well say it, like the big disadvantage. So when I talked about that dollar or that $100 coming in up here, what I look to my clients is I say, if an incorporated individual is taking out money specifically for putting it into the TFSA, instead of them putting in that whole $100 that they earned, they're only putting in 50 to 60 of those dollars that they earned, because by the time it gets down here, they've been taxed a few times. So of that full 100, they're actually only putting in about half. So that's a big disadvantage to business owners with the TFSA. With the RSP, at least you get the tax credit for putting money into it. So you get money back for putting money into it. So then you're putting in, approximately of that $100 you earned, you are still putting in about 90-ish of what you earned into it. But it does have the whole thing hard to access, or not impossible to access, but a little bit harder to access than TFSA. You are going to get
rules on it to be able to.
Yeah, you're going to, exactly. It's tax deferred, but it will all be taxed as income to the estate as soon as the last spouse dies. So that's a limitation of it. But I've run the numbers, and if a doctor comes to me and they, most of my clients, it doesn't make sense for them to have a tax-free savings account actually, because of the fact that they're putting 50 cents in rather than 90 cents, or up here, the whole 100. I should stick to $100. Instead of putting in the $50, they're either putting in 90 of those dollars here, or actually something we're going to talk about in a second, where you can put the whole 100 in.
Well, and I think a big difference between Canada and the US is like your taxes are already super high, right? Like in the US, one of the reasons I don't believe in putting as much money in a 401k, and it's a little different because a lot of people have like employer matches and stuff like that. But let's assume that it's no employer match, which a lot of companies are going to. We're in a lower tax rate right now. And I mean, look at our debt in the US, it's like it's going higher and higher. We're almost at 30 trillion, right? So taxes are going to go up. They have no choice but to go up. So like deferring in a low tax bracket only to take out later when taxes in every bracket are going to be higher is kind of absurd when you think about it. But like in Canada, you guys are already pretty high tax brackets, right? Like, so you have to take that into consideration.
Oh yeah, definitely. Like most of my clients, what they do with their accountants, what we work out is they pay themselves enough salary to max out their room with this. Because there's a bit of a difference between salary and dividend. I won't go into that right now, but usually they max out enough to get this maximized salary. And then they dividend the rest, or they don't even take out the rest if they don't need it. Like if someone doesn't need the money personally, the general consensus is leave it in the corporation. Like if you don't need it personally, don't take it out because that personal tax bracket is typically high. So yeah, definitely. No, good question. So with the whole life, we've talked about this a bit. So the beauty of a corporation holding it is that $1 million I talked about, of like, if you have $1 million kicking out 50,000 a year of investment income, whole life is completely exempt from that rule. So what you're putting in there does not show up on that balance sheet of a passive asset inside of a corporation. You have to report the value every year, but it doesn't get taxed, as it's growing. It just gets to sit there. Your premiums are paid by the corporation. So the beauty of it is that you're not putting in that whole $100 into the premium, but you're putting in those $90 of the 100 you've earned. So that's the beauty of it. So it gets to grow inside of the corporation tax advantaged. When you go to, one of two things happens. One thing is a person passes away, the death benefit lands inside of the corporation, a whole bunch of money for their either business partner or family. They can take it out. The death benefit doesn't come out entirely tax-free, but if they've been doing it long enough, it comes out quite tax advantaged. So that comes out, and that helps with a lot of that layer of tax. The other option is to borrow against it. So that whole life policy can be used as collateral to a loan. So it's basically, so this is one of the first steps of creating your own pension in retirement.
Man, that's crazy.
Yeah, as you've got this, you can basically turn that portion of your corporation into a tax-free line of credit that you can then access. So the basics of it are, you're basically putting the money into the corporation, and it is bypassing the income that you take out from this. The money you take out from this when you borrow it does not get added to your income, your personal income. It bypasses that. So very attractive long-term strategy for my clients is to build this up as one of the three places where one of the big three places that they're going to get money in retirement. If they don't need it, it's a legacy. They can leave it. It can help with estate taxes at the end of the day, of which most of my clients have a lot of potential estate taxes because of the way Canada's structured. Estate taxes are they're high. Or if they need it, they can use it to buffer that. So when they're in retirement over here, and I'll just make some more room over here. Like when they're in retirement and they need that income, because cost of living is going to continue to go up, right? So someone who needs 100,000 today in their jeans at 42 is going to need like 200,000 a year in their jeans at 65, right? Like it's because of inflation. So when I look at that number of how much they're going to need in retirement to live off of the rest of their life, we look at, okay, how much of it could come from the whole life insurance? Like that's how much.
Yeah, kind of like in the United States. I mean, some people have pensions, some people we get Social Security. I'm not sure how that works. Do you guys have an equivalent to like Social Security up there?
Yeah, we have something called the Canada Pension Plan. So this is another interesting topic, is that a lot of people, when I first became a financial planner, a lot of people were just taking dividends from their corporations. But when they were doing that, since they weren't taking salary, they weren't generating RRSP room, and they also usually weren't contributing to Social Security, which up here is called Canada Pension Plan. So that is part of it. Like it's not a ton of money, but it does factor in. Like, so I look at, we call it CPP. It's part of what could come in.
Like cover like 10 to 20% of it kind of thing.
Yeah, something like that. And then there's another thing called old age security, which is also commonly referred to as old age pension. That is something you get. So CPP is completely based on how much money you made.
Okay.
So most of my clients, like I said, they max out their income to max out RSPs. They're usually going to have max CPP. Okay. Old age security is more based on how much time you spent in Canada as an adult. Like if you spent most of your adult life in Canada, you're going to get max OAS, which is I think like $600 or $700 a month right now.
Okay.
It is taxable. CPP is taxable, but it helps. Like it helps with, certainly it helps but it's not dependent on income. It's just everyone kind of gets it.
Okay.
I won't get a lot because I haven't lived in Canada my whole adult life, so
Right.
I won't get the whole thing. But
Well, let's face it, if you're trying to bank on $600 or $700 a month, making a big difference in your life, probably.
no, it's there. Like when I run my illustrations, I put it because why not? But it's
Yeah,
certainly
well,
not.
fair.
It's certainly, it's great. Like, I mean, I love the fact that there's people out there that they need that. And so it's
Oh yeah,
fantastic.
totally.
Like it helps them out. Like, I think it's a great thing that the government has. So those are the, yeah. So that's the thing that would be close to, Social Security is CPP. In other provinces, in Quebec, it's called something else, but most of it's
Gotcha.
CPP. So yeah, so you look at that, that's going to generate a little bit. We look at, okay, the whole life. And I mean, really what I look at with my clients is, like I said, it's kind of like when I look at people in retirement, I think of it as, let's say you're going to the well to draw this water to like live off of in retirement. And I'm like, okay, how much of that can come from groundwater? How much of that can come from rainfall? How much of that can come from snow melt? Like all the different sources.
Sure.
And you can decide in retirement which one makes most sense to draw from. Because with the whole life, you're never forced to take the money out like you are with RRSP in Canada. When you turn 71, you have to start taking out some of it.
You have RMDs, like
required minimum distribution. Yeah, you have to take out a minimum. The percentage is pretty low. So, I mean, for most people, most of my clients, they're going to be taking out more than the minimum because why not? Like it's also to draw that future tax problem down in retirement.
Right.
Like most of my clients, we look at trying to get them with as little as possible left inside of that at the end of their life expectancy, and then drawing that money, the rest of the money from other places. So, so no one's forcing you to take this out. So usually I look at my clients, I'm like, let's actually push that out a bit to give that tax deferred growth more time. And then the other one is what I'm going to talk about right now, which is the individual pension plan. So individual pension plan it's really interesting. Not a lot of accountants are familiar with it yet. In the next couple of years, everyone's going to be doing this. But right now, it's a little bit new on the scene. It's not new on the scene, but it's just not like common. So the way it works is that. So when I talked about that first layer of taxation, the beauty of the IPP is it's very similar to the RRSP, except it's like a corporate version of that, which means that instead of you getting the tax deduction at a personal level, you actually get it at a corporate level.
Okay.
So that $100 that the corporation earns, you can actually put the whole 100 inside of the IPP.
Oh, and what's IPP stand for again?
Individual pension plan.
Okay.
Yeah, so I'll do that. Individual.
And how do you structure like an individual pension plan? Is that a whole life policy? Is that a different type of asset? Is it what?
Yeah, good question.
What is the actual financial vehicle that you can utilize for an IPP?
Yeah, it's a good question. So the IPP holds investments, like traditional type investments, like mutual funds and things like that.
Okay.
And the target rate of return for most individual pension plans is 7.5% per year. That's like the formula that it's based on.
Okay.
And so clients do have a say as to how it's invested somewhat. Most of my clients are fairly aggressive investors. They've got a lot of time. They understand that the short-term volatilities in the market exist, but long-term, go over historically it's gone up. So they do have a say as to how it's invested. But I mean, really one of the big wins is that a lot of people just don't know about is it's a corporate write-off, like the money that goes into the IPP. So it's that full 100 that gets to go in there.
So tax deferral.
Yes. So the beauty of it is that first layer of tax that I drew before, that first one that goes over here, that 10% or so, that you're recapturing that 10% of that amount that you're putting in, and you're actually getting to put the whole thing in there. So it's a beautiful thing that we can actually control, because that's what I talk about is like, let's control what we can control.
Yeah. Amen.
So with my clients, usually it doesn't make sense to look at these until you're around 40, because there's a pension formula that forms a part of it. So in order for someone to qualify for this, I'll talk about that. They have to have a history of T4 income, which is salary income. They have to be
out of their own corporation.
Have their own corporation, exactly. Corporation. Be T4 income, corporation. What else? It's about 40 or so. 40s is usually a time when I start looking at it for my clients, because the pension formula just kind of makes sense at around that age.
Okay.
The other beauty of it is that so what my clients typically do is we build up money here in the RSP. And then the beauty of it is when they open the IPP, they can actually transfer money over
No
here,
way. On a
or
tax
they can,
favored basis?
yeah,
Really?
just rolls in. Yeah.
Nice.
Or they can take money from their corporation and roll it in as well. So
So,
my clients that are in their 30s or 20s, usually they're at least in their 30s, but it's not, I mean, I have clients in their 20s too, like young doctors. We're building up the RSP, sometimes even the TFSA in those early years when they're earning a salary and they're not incorporated yet, it can make sense. But then once they incorporate, we start looking at, okay, let's take this buffer we've built and start putting it into the IPP. Because at the end of the day, one of the things that happens to my clients is, in all honesty, it's a good problem to have. And a lot of people wish they had this problem, but they run out of places to put money to try to generate a pension later on in life. Like they run out of places because the corporation has been hit with this new rule of like, once you start generating 50,000 a year in passive income, the tax grind kicks in. So the RSP is usually not enough. And it honestly isn't enough for a lot of people, but they just don't know it yet. But the beauty of the IPP is you can put more money into it. You have to learn. There is a cap on it. It's a formula. Like I said, it's a formula that I run for each person. But what happens over time is the amount that you can put inside of an RSP, if all you did was the RSP versus the amount you can put in IPP, it starts the difference starts being substantial. The longer it goes, you can dump more money into it. And so that's the third kind of place I look at is, okay, how much is coming from here? How much is coming from here? How much is coming from here? Again, when my clients go to retire, then it's a question of, because the longer you defer the IPP, the better it's going to look. The longer you defer the whole life, the better it's going to look. But we just look at what makes sense. Like, does it make more sense to do this, to do that? The other big benefit from the IPP is that if the person who has the IPP has a spouse, they can split the income that comes out of there to help level out the tax brackets.
Nice.
So in retirement, it's a huge, huge win to be able to split the income that comes out.
Do you not file in Canada jointly? So it's all household income? Does each person have their own tax bracket?
Yeah, you have to, in retirement, you pretty much have to elect to split income. And so all my clients do it because as far as I know, their accountants are splitting their income because it never doesn't make sense usually. But it does depend on what kind of income they're getting. Like, so usually you can do it. So usually you can split. The IPP is a great way to split the income between spouses.
So I'm not going to lie. I mean, I'm seeing you do this and I'm just like, wow, I want to move to Canada and get my license again because like I could sell the crap out of this. Like, this is like the biggest no-brainer in the world.
It is. And I mean, what I'll say is that, so like the question could be, how come people aren't kicking down my door asking for this? How come
that would be my question.
How come accountants aren't prescribing that?
Yeah.
The biggest thing is people just don't understand it that well. Like RSPs have been around since like the 1950s, I think.
Okay.
People understand them. TFSAs have been around since 2008 or 9. People get it now. People have been using it. The accountants I meet with, and I meet with accountants that have hundreds of incorporated clients, and I ask them, have you ever done one of these? And they say, no, not yet. And it's because they just don't understand it yet.
Okay.
But I meet with them and I explain it to them. And so like some people might say, actually, one big thing to note is that one of the things that kept people from using these was it was hard to get at the money once it was in there. And people would say, I'm nervous about my clients locking money into a pension structure.
Of course.
But this year, some legislation went through where it's actually much easier to get at it. Like if someone needs to just pull the pin on this, they can. They can access the majority of the money again if they need to. Like, so for my clients, they've usually got money in other places. So like when they commit to the IPP, we do it in such a way that it's like, okay, I'm good. I'm not worried about this 20 something grand I'm putting away every year, 30 grand. Eventually it gets bigger than that. We're good. I don't need this money. Cool. But, sometimes accountants tend to be more conservatively based people. And so they get a little bit worried about locking money away. But that consideration is actually pretty much gone with this new legislation. Yeah. So it's more of just a newer thing that accountants are having a little bit of trouble wrapping their minds around. But within a couple of years, it's going to be like accountants are going to be prescribing this to their clients potentially. Okay. So luckily I've been studying it. Like I don't put anything in place with my clients until I fully understand it. Yeah. And I studied the IPP for a long time before I fully understood it because I have to understand it well enough to make it simple. Right.
What? Yeah,
So
no,
that
absolutely.
now I can make it simple.
What is like the kind of baseline bottom end income that you kind of find that people don't qualify for, or that they need to be able to have this make sense on the bottom level?
Yeah, for sure. So we're usually looking at someone who's drawing in the neighborhood of $150,000 a year from their corporation,
Okay.
which is pretty common. Like that's the range to start looking at maxing out RSPs.
Okay.
Pretty common for, just to give a ballpark, like just so I'll talk about an actual case study. I mean, I'm not going to go into huge numbers on the IPP. It would take me a minute to pull up an illustration, but
Mhm.
like let's just say I've got a doctor who bills 350,000 a year
Mhm.
to the corporation.
Mhm.
He only needs to live off of like 160,000 a year.
Sure.
So he's got a lot left behind in the corporation. This
Yeah.
is in the neighborhood of maxing out the RSP. So, like I said, before my clients do IPPs, the RRSP is a perfectly suitable place to put money. Typically, they're
Mhm.
doing that, maxing that out. That's going up every year. So pretty common. And then they've still got some. Usually my clients have in the neighborhood of 100,000 or more, adding, in the neighborhood, I'd say of per year, 50 to 100 per year. Adding to the corporation that they don't need to actively manage the
Okay.
company or manage the corporation.
Okay.
But yeah, I'd say in the neighborhood of one. I run it for every client just to see, but and most people, if they're incorporated, that's what they're making. Like in Canada, the rule of thumb is around 120 to 150 for it to make sense to incorporate, because there
Gotcha.
are costs associated with incorporating. You have to pay for a lawyer to incorporate you. You have to pay for an accountant to do your new corporate
Totally.
taxes.
Yeah.
Yeah.
Yeah, that makes sense. That's awesome. Yeah, I mean, it to me just taxes is one of the greatest, killers of wealth potential, in the world. And your guys' taxes in Canada are far, far higher than ours in the United States. And it seems like you have far fewer loopholes and ways that you can kind of be creative to avoid taxes. I mean, look at Warren
Hmm.
Buffett, and stuff. People like him is like they're if you're creative and you make enough money in the United States, you can get away with, I mean, not paying much at all,
Yeah.
and just reallocating resources and just making certain investments and deferring income and all these different things that can make it so you're paying 15% and making $1 million. It's pretty crazy, which,
Wow.
I mean, it's nuts. I mean, I love it, but it's crazy. So in the United States, that's the case. In Canada, that's not the case at all. So like all the things that you're talking about, I mean, it makes all the sense in the world. Like every objection to
Stuff
somebody that
change.
somebody makes for like kind of our strategies in the United States all have to do around taxes and the fact that like why do that? Because like most people aren't going to pay that many taxes.
Mm,
And I could have, I mean, that's not the place for this video. Like I have plenty of rebuttals and arguments and like
sure.
facts that I could prove them so wrong on a lot of levels. But for Canadians, like if you're in this high tax environment and you're not in a situation where taxes are low and going to get higher, you're just there now, and chances are they're probably going to be pretty level. I mean, once taxes are at 50-60% on the high end, like how much worse can they really get? Like
Yeah.
not very.
Oh yeah.
I mean,
No,
without
definitely. And I mean,
complete.
and it, yeah, definitely. That's what I've seen when I can always tell when someone has read a lot of information from the States,
Yeah.
because they'll come to me and they'll say, "Oh, I've heard this is not a good strategy because of XYZ."
Yeah,
And I'll be
yeah.
like, "Where'd you hear that?" And they're like, "Oh, I read it on a blog." And I'm like, "Send me the email." And it's like different words too. Also, like up here in Canada, fiduciary is not really a
Oh, yeah,
term that's thrown around, and like
yeah.
advisor versus advisor, like O versus E or whatever. But no, the tax thing, yeah, definitely. I saw in a blog, it was someone saying like doctors they were like doctors should not implement any strategies around estate planning because they won't have any estate taxes because of something called a step down rule or something.
Yeah, yeah.
And I'm like, not in Canada, man.
Yeah.
Like you are going to
Oh,
lose half of it to taxes when you die, like
totally.
easily half of it.
Mhm. Yeah, no, and if that's the case, I mean, you just have like it's imperative you do something of this nature. And if you don't, I mean, why wouldn't you? If you don't, you just might as well just light money on fire and have a party. Like it doesn't make any sense.
Yeah, I mean, the biggest thing that I find is just people just don't know. Like I'll meet people consistently, like every year I get in front of people who have a million plus inside of this thing that's called an RSP. They're in their
Yeah.
60s and 70s. And I say, cool, how much of this would you like to go to your kids, grandkids, or church? And they say, oh, I'd love for all of it to go. And I'm like, yeah, probably about half of it's going to go. And they're shocked. And they've been with an advisor for years, and no one ever told them this. No one ever told them to fix the problem. If I meet them early enough, we can work on the problem. We can slowly move them from what I call the red bucket, which is the fully taxable, to the green, which is the fully tax-free. But sometimes it takes a decade to, it could take over a decade.
You got
to
to ladder it over, right? You can't just,
you can't do it all at once. You'd be brutal. So it's mainly just because no one's ever told them. No one's ever said, you know, like when RSPs came out, it's kind of like this blanket drive-through advice. Everyone should just max it out, and that's all they should be doing, nothing else. But then as time went on, it's like, oh, like this is actually causing a problem. So that's the big thing I bring to the table is I've worked with clients at all stages of their life, all the way from, you know, 20 something to 90 something. And I see which problems people are encountering at each stage. And so it's like, all right, if I'd met you when you were 30, I would have told you this. So then I can go to my 30-year-old client, my clients in their 30s, and be like, these are the things you're going to wish you had done when you're in your 70s and your or 90s, when you're in like this now.
Totally. That's awesome. Well, that's awesome, man. Is there anything else that you think we need to cover in this? I mean, like that, it just, I see this and I'm like, duh, no brainer. Like if I'm in that camp and I'm watching this video, I'm reaching out to you and wanting to have a conversation. So I guess if that is you and you want to talk to Galen, if you have any questions about what you have going on, I'll put a link below. You can just go and have a conversation with him. And you know, like he's, as you can tell, he's pretty chill, easy to talk to. He's a wealth of knowledge and licensed. Right, you're licensed in like 4 different provinces. So
yeah, I'm licensed all over the place. I'm licensed in Nova Scotia, British Columbia, Ontario, Alberta, and Manitoba. I'm on the phone with Manitoba because I gotta get licensed there because I got a couple people asking for help there. But I mean, if someone put one of these in place, I'd just get licensed in whatever province they're in. If I've missed it, I don't have that many left, but I have a few left.
Nice, that's awesome. Well, that's cool, man. So no, I think that's fantastic. I think the information. I can't believe I didn't know this, first of all, and I think if you're somebody who has a corporation or is looking to go that direction, like knowing all this information ahead of time to be able to plan for it is, I mean, if you're not, it's just going to cost you money. So that's awesome, man. Well, guys, if you like this video, if you found value in it, please hit that subscribe button. Once again, hit the bell, that way you get notified, because Galen and I are going to be doing this series for personal finances for Canadians. Once a week, we're going to be launching these videos and just bringing as much value as possible. So if you have any questions, what I'd also ask for you is in the comments below, if you have any specific topics or questions that you think are important to you around all this stuff and you're having a hard time finding information, then go ahead and ask it. And we'll make sure that like in the videos that we create, that we try to answer any of those questions that we possibly can, because that's what this is all about. So I guess until next time, have a blessed, inspirational day, and we'll see you next week.